Okay, let's unpack this. Welcome to the deep dive where we try to make sense of all the financial chaos out there. You know, the data, the headlines, the stuff that moves markets up and down like crazy. We filtered all down to give you the core insights fast and clear. Today, we're diving into November 12th, 2025. And honestly, if you just glance at the headlines, you'd think, wow, great day for the bulls. The Dow Jones Industrial Average, it surged, hit a
Yeah.
brand new all-time high. Depending on where you looked, it closed right up there, maybe around 48,410. Incredible, really. But, you peel back just one layer, just one, and suddenly the picture looks very, very different. It feels like the market's standing on a knife's edge.
That's exactly the word for it, an inflection point. And that tension, that's really the theme for our whole deep dive today. Our mission, really, is to figure out why the market is so bifurcated, split, right down the middle.
Yeah.
It seems caught between that euphoria, the political good news driving the Dow, and this massive, immediate economic risk hanging over everything else.
Very. And you could see that tension playing out right away in the futures market overnight, couldn't you? It just screamed investor indecision. If you looked at the E-mini S&P 500 futures, the main proxy for the broad market, they were barely up, what was it, like 4.5 points, 0.07%, basically flat, just idling.
Totally flat, exactly. The S&P just sitting there waiting. But then you look at the tech side.
Yeah.
The E-mini Nasdaq 100 futures, that was actually lagging.
Yeah.
Showing relative weakness, down about 18 points or negative 0.07%.
Okay.
So that subtle difference, broad market flat, tech weaker, it tells you the market is just fundamentally coiled. It's like a spring ready to jump one way or the other.
Yeah.
Just waiting for some kind of real catalyst.
And it's worth pointing out, right, this caution kind of flew in the face of what should have been pretty good news, especially after hours, like with AMD. That kind of news, usually you'd expect it to pull the whole market up, but nope, not this time. It wasn't enough to break through that wider uncertainty.
And that sets up the core conflict perfectly. It's this profound clash between two totally opposing stories, two narratives. Narrative one, this really powerful risk-on rally. It's fueled by the political good news, the fact that this historic 43-day federal government shutdown looks like it's finally ending. That's a huge weight off everyone's shoulders.
Yeah, the relief factor, like, okay, the government can actually function again, which, I mean, it feels like a low bar for a major economy, but for sectors tied to, domestic stability and funding, it's a big deal.
It is a big deal. But then you have narrative two pulling in the complete opposite direction. It's an aggressive risk-off rotation. And this is driven by these deep, nagging worries about valuations, especially in those high-flying tech stocks, plus just this crippling economic uncertainty that's been building for weeks now.
Right. And that uncertainty leads us straight to the central problem, doesn't it? The informational vacuum. This is what makes the next couple of days feel so unique, so critical. For what, over 6 weeks now? Federal agencies like the Bureau of Labor Statistics, the BLS, the Census Bureau, they've basically been dark because of the shutdown.
Completely dark, which means the market, and maybe more importantly, the Federal Reserve, they've just been groping around in the dark. That's the only way to put it. They've had to trade on unreliable proxy data, maybe some regional surveys, or just pure sentiment for way too long. Think about all the crucial numbers we rely on. Retail sales, factory orders, consumer confidence, just gone. It's like we've been living in an economic ghost town.
And now, with the shutdown ending, the immediate danger is this data bomb. We're about to get hit with a super compressed schedule of all those delayed high-impact government reports, starting right now. So this collision, this mashup of political relief and incoming economic reality, that's why this moment is so absolutely crucial for you, the listener, the investor, to understand. Okay, so let's dig into the actual market performance from Tuesday, November 12th. Because like you said, our sources called it a study in contrasts. And they weren't wrong. You could look at the tape and feel incredibly bullish or incredibly bearish, really depending entirely on which major index you happen to be watching. There was a very clear winner, the Dow Jones Industrial Average. It didn't just rise, it surged, closed up, 1.18%. Hitting that record closed right around 48,410. That's a huge move, especially with all this background noise.
Oh yeah, that's pure unadulterated political optimism right there. That move was almost entirely driven by the expectation that the shutdown was over. You had the Senate approving the funding bill late Monday. The House was expected to follow suit late Wednesday. Boom, relief rally triggered.
But that relief didn't lift everything, did it? It was incredibly selective. It wasn't just a rising tide lifting all boats.
Not at all. Highly selective. The money specifically poured into cyclical stocks, value-oriented sectors.
Okay.
Think about the big industrial companies, basic materials, consumer discretionary, healthcare. These are the parts of the market that are most sensitive to government funding returning, to just having data certainty back.
Right.
Investors weren't necessarily betting on explosive economic growth yet. They were just celebrating the return of some basic stability.
Yeah.
Like, okay, we can function again.
Okay, but then you pivot. You look at the other side of the market, and you've got the definite loser for the day, the Nasdaq Composite. It actually went down, closed off about 0.5%, landing around 23,429. This just hammers home that this great tech rotation isn't just some theory, it's happening and maybe even speeding up.
It's accelerating. It's the risk-off driver really pushing that aggressive sell-off in the high-valuation tech names. And if you look inside the market at the sector level, the S&P 500 technology sector was the only sector to finish in the red on Tuesday.
Wow, the only one.
The only one. That's a massive signal. When basically every other sector tied to stability or value is going up, but tech is going down, it confirms this isn't random noise. It's a deliberate, purposeful rotation out of growth and maybe into safety or perceived value.
So let's unpack that rotation a bit more. What's the specific fear driving people out of tech, even when the broader mood seems optimistic about the shutdown ending?
Well, the underlying concern is this persistent, almost nagging belief that the whole artificial intelligence rally, the AI story that's basically driven the market for the last year and a half, that it's created a pretty significant valuation bubble. Analysts are openly drawing lines back to the dot-com bubble excesses. They're looking at the metrics.
Like what kind of metrics?
Back in the late 90s, the big red flag was often price to sales. Companies had revenue, maybe, but often zero profit. Now it's a bit different. The concern isn't zero revenue. It's more that the future earnings growth you need to justify today's stock prices. Well, it looks almost impossibly high for some of these names.
Can you give us a sense of that? Like, how stretched are we talking?
Sure. So analysts point out that back before the 2000 crash, some big tech names, even blue chips like Cisco, were trading at crazy multiples, maybe 80 times forward earnings. Now you look at some of the core AI infrastructure players, the ones making the GPUs, building the clouds, some are hitting 60x, even 70x forward earnings. And crucially, they're doing it in an environment where interest rates are way higher than they were in 2000.
Right. Higher rates make future profits less valuable today.
Exactly. So those high multiples today, they just flash massive red flags. It feels like the market is pricing in absolute perfection. And then you get something like the SoftBank news, which we'll get to, and it suggests some really big players are thinking, yeah, maybe that perfection isn't going to happen.
Yeah.
And we saw this rotation clearly in the data, too. Bloomberg has that Magnificent Seven index, right, those mega-cap tech stocks that basically were the market rally last year. That index fell 1.6% during Tuesday's session. That's serious money rotating out.
Yeah, that's not insignificant. What's fascinating here, though, is how the S&P 500 just got caught in the crossfire. It only managed a tiny gain, like 0.2%. It couldn't really follow the Dow's big jump because tech, being such a heavy part of the S&P, was dragging it down. But it didn't collapse like the Nasdaq either. It really paints this picture of extreme selectivity. The political relief rally only seemed to cover, 2/3 of the market, while the other third was actively unwinding. Okay, so the Dow hitting a record high, that just screams optimism, right? Like everything's great, gridlock's over, economy's ready to roll. But if we broaden our view, if we look beyond equities to the other big asset classes, bonds, oil, gold, they were sending completely different signals. They were flashing clear risk-off warnings, caution signs everywhere.
Unambiguous warnings.
This is that core dissonance, right? The stock market, or at least the Dow part of it, is partying like it's 1999 or maybe 2025. But the smart money elsewhere, the bond traders, the commodity guys, they seem to be hedging their bets, preparing for economic weakness, or maybe just a big data shock. So why? Why would the bond market, of all places, be fighting the Dow's rally? What's going on there?
That's the million-dollar question, isn't it? If you genuinely believe the shutdown ending meant smooth sailing and strong growth ahead, you'd be selling bonds, taking on risk, buying stocks.
Yeah.
But what did we actually see in the Treasury market right after the Veterans Day holiday? We saw investors aggressively buying bonds. Classic flight to safety. Textbook move.
And the result of that buying, what happened to yields?
The benchmark 10-year Treasury yield, the one that influences mortgage rates, corporate borrowing, basically everything, it fell pretty sharply. Dropped by, sources said, 3 to 6 basis points. settled at a really key level, right around 4.07%, maybe 4.08%.
Okay, and just for listeners, a basis point, a BPS, is 1/100%. So 6 basis points is a decent move down for yields in one day, especially after supposedly good news.
It's significant because in a real, sustained growth rally, yield should be going up. Risk appetite increases. Money flows out of safe bonds. The fact they fell tells you investors are hedging. They're betting against the Dow's optimism, protecting themselves against two main risks.
Okay, what's the first risk? This data bomb hedge.
Buying bonds is the classic way to protect yourself if you think inflation is about to surprise on the upside. If that CPI report we're all waiting for comes in hotter than expected, fear ripples through the market. When fear hits, bond prices usually rise, yields fall, protecting the bondholder. So bond traders are essentially locking in yields now, betting that the economic data reality is going to be worse, maybe hotter on inflation, than the political relief suggests. They're betting against the happy disinflation story.
Got it. Hedging against bad inflation news.
Yeah.
And the second risk ties directly to the Fed, right?
Correct. It's all about Fed policy pricing. The market has gotten incredibly aggressive about this. Right now, it's pricing in something like a 63% chance of the Fed actually cutting rates as early as December.
63%. Wow. Where did that come from?
Well, it's been building, largely fueled by some of that weak proxy labor data, like the ADP jobs report, that we had to rely on during the shutdown's information vacuum.
Yeah.
So bond traders are locking in current yields around 4.07% because they think the Fed will be forced to cut rates soon. If the Fed does cut, yields will fall further, and the bonds they bought today will be worth more. They're betting the Fed won't be able to stay tight for long.
Okay, so Treasury's flashing caution. But the risk-off signal get even louder, maybe more violent, over in commodities, didn't it? Specifically crude oil, which is super sensitive to global economic health.
Oh, absolutely. WTI crude oil just collapsed, down more than 4%, hit a three-week low around $58.40, $58.50 a barrel. And crucially, this wasn't just nervous traders selling futures. This was driven by a major fundamental shock that came directly from OPEC's own monthly report.
Okay, OPEC. What did they reveal that could cause oil to tank by 4%?
They dropped a bombshell, really. Their report showed an unexpected surplus of crude oil in the third quarter, like 500,000 barrels per day surplus, 500,000 barrels.
Wait, a surplus? If the global economy is supposed to be recovering, how could they end up with so much extra oil sloshing around?
Well, that's exactly the point. The market interprets that as a hard signal that global economic demand, maybe especially from places like China or other emerging markets, is weakening faster than people thought. If factories slow down, if shipping slows down, you just don't need as much oil. So that OPEC report basically undermined the whole global growth narrative that a lot of investors were counting on.
And there was technical confirmation too, right? Something about the oil market structure changing.
Yeah, exactly. For the wonks out there, the WTI's nearest time spread, that's the price difference between delivering oil this month versus next month, it briefly flipped into what's called a bearish contango structure.
Okay, contango. Can you break that down simply?
Sure. So usually, in a healthy market with strong demand, you're in backwardation. That means the price for oil right now, for immediate delivery, is higher than the price for future delivery. People need it now. When it flips to contango, the future price is higher than the spot price. It suggests people are willing to wait, maybe pay a bit more later because they don't need the oil urgently right now. If it flips into bearish contango, especially right at the front of the curve, it's a strong signal of an immediate supply glut. Too much oil right now, nowhere to put it, and weakening demand for prompt delivery.
Got it. So Treasury's cautious, oil collapsing on fundamental weakness. Where did investors run for cover amidst all this? Gold.
Gold, the classic ambiguity trade. And its move was really telling. Gold prices jumped over 1.3%, getting up near $4,180, maybe $4,200 an ounce. And the commentary directly linked this move to the extreme uncertainty caused by the shutdown and that looming data bomb. With no reliable U.S. economic data, the ultimate information vacuum investors basically had to treat gold as a primary store of value. They couldn't fully trust government bonds, couldn't trust equities, so they went for the metal.
Yeah, if you can't trust the official numbers, you trust the shiny rock. Makes sense.
Pretty much. And you've got broader forces supporting this too, like that recent World Bank outlook predicting new all-time highs for gold because of all the global uncertainty and geopolitical risk. Gold isn't a bet on growth, it's a bet on chaos, maybe currency devaluation.
Okay, let's touch quickly on crypto, because Bitcoin seemed to offer a bit of a counter signal, right? At least in terms of institutional money flow. It managed to stay above $104,000.
Yeah, BTC stabilized above 104K, even touched $105,410 briefly. Now, it's always volatile, but what underpinned that move was a really chunky inflow over $500 million, $523.98 million, flowing into those U.S.-listed spot Bitcoin ETFs.
$500 million in a day?
Yeah. That signals serious institutional capital coming back in after maybe some recent profit-taking. It suggests that these big players might see crypto as, I don't know, a non-correlated asset, something less directly exposed to the immediate U.S. domestic data drama, the shutdown fallout, the CPI report compared to traditional stocks or bonds. Maybe a cleaner way to keep some risk exposure without betting on the BLS data schedule.
Okay, so we mentioned the market is pricing in these aggressive Fed rate cuts by December, basically betting on a dovish pivot. And you said that optimism isn't just wishful thinking, right? The support for it actually comes in part from the Federal Reserve itself.
That's right. There's been a real foundational shift in monetary policy that we need to zoom in on.
But now, with the data vacuum ending, that whole dovish pivot narrative, which kind of grew in the fog, it's about to get hit with the dose of reality, isn't it?
It's about to be seriously tested, yeah. So Roberto Perli, he's the manager of the System Open Market account, SOMA. He officially confirmed the FOMC's decision. They are ending their balance sheet reduction program, what we call quantitative tightening, or QT, effective December 1st.
Okay, let's clarify that. SOMA QT. Why is stopping QT such a big deal for the market?
Okay, so SOMA is basically the Fed's trading desk. It's the arm that actually buys and sells assets, mostly treasuries and mortgage-backed securities, to implement monetary policy. Quantitative tightening, QT, is when SOMA shrinks the Fed's massive balance sheet. They do this by letting their existing bonds mature and just not replacing them. They don't reinvest the money.
So QT removes money from the system.
Exactly. It literally pulls liquidity cash out of the banking system. Think of it like a giant sponge soaking up money from the financial markets. For months, the Fed had been shrinking its balance sheet by tens of billions of dollars every single month. That was active tightening of financial conditions.
So stopping that is huge, taking the foot off the brake, essentially. What was the Fed's official reason for shifting from tightening to, well, neutral?
Perli mentioned changes in money markets and the need for the Fed to kind of step back and assess bank reserve levels. Basically, there were signs of tightness showing up in the short-term funding markets, where banks lend to each other overnight. It suggested some banks might be running a bit low on reserves, the cash they have to keep parked at the Fed.
Ah, okay. They don't want a repeat of liquidity drying up like we saw a few years back.
Precisely. They want to avoid any plumbing issues in the financial system. So by stopping QT, the Fed is explicitly saying, okay, we're done actively tightening for now. We're moving to a neutral stance. Let's make sure there's enough cash in the system. But the market hears that and immediately translates it as, okay, neutral is just the necessary first step before they start actively easing. It's seen as the prelude to the rate cuts everyone's hoping for.
But those hopes, like we keep saying, were largely built during that shutdown fog, right? When we didn't have real data.
Absolutely. You have to remember Fed Governor Austin Goolsbee saying that the informational fog made him really cautious about making big policy moves, like cutting rates. He knew the data they were seeing, like that weak ADP jobs number, probably wasn't the full picture. So now the market is basically flying blind into this data reality, trying desperately to validate a dovish pivot that was priced in based on speculation and, frankly, political relief.
Okay, here's where it gets really interesting then. Because that data reality, it's hitting us fast and hard. This data bomb means the BLS, the Bureau of Labor Statistics, is about to unleash this incredibly compressed schedule of all the critical data we've missed. It's like a dam breaking after 43 days.
And literally every single investor, every trader, every analyst have their calendar marked for one specific event, the ultimate market catalyst, Thursday, November 13th, 8:30 a.m. Eastern Time, the release of the October Consumer Price Index, CPI.
This isn't just another report, is it? This is the report. It's the first official inflation reading we'll have had this quarter. It is the single biggest test of whether this whole disinflation story, this rate cut narrative the market's been clinging to, is actually real or just wishful thinking.
And, when that number drops, analysts aren't just going to look at the headline CPI figure. They'll rip it apart immediately. They need to see the month-over-month change slowing down, sure. But the real focus, it's going to be on core CPI. That's the one that strips out the volatile food and energy prices.
Why is core so critical?
Because if core CPI comes in sticky, if it shows inflation is still stubbornly high in services like housing costs or wages, then that 63% probability the market has priced in for a December rate cut, it's going to evaporate instantly.
Wow. Okay. And it's not just CPI landing at 8:30 a.m. Thursday, right? It's a whole cluster of data points hitting at once. Truly a data bomb.
It really is. At the same time, 8:30 a.m. Thursday, we also get real earnings for October. That's crucial because it tells us if people's wages are actually keeping up with inflation. If real earnings are flat or falling, consumers have less spending power, which signals a potential economic slowdown. And we also get the weekly initial jobless claims. Now, this is one of the few real-time labor market indicators we've had during the shutdown. Seeing how this number lines up with that weaker ADP proxy data will be key. Is the labor market really cracking, potentially forcing the Fed's hand? Or was the ADP report just noise?
And the pressure doesn't stop on Thursday, does it? Friday morning is big, too.
Nope. Friday, November 14th, again, 8:30 a.m. Eastern, we get the Producer Price Index, or PPI, for October. That's the other side of the inflation coin. It looks at prices earlier in the pipeline, what manufacturers and producers are paying. Often, PPI trends can signal where consumer inflation is headed a few months down the road. Plus, we get U.S. import-export prices for October. That gives us a read on global price trends and whether we're importing inflation. That's especially relevant after that OPEC report hinted at global demand weakness.
So, bottom line, the number one risk is crystal clear. A hot CPI print.
Absolutely. If CPI comes in higher than expected, it just directly attacks the market's entire foundation, this belief in a friendly, dovish Fed ready to cut rates. If inflation is still sticky, the Fed simply cannot justify easing policy. And the whole rationale that's been supporting stocks through all this uncertainty just crumbles. Honestly, the next 48 hours, probably the riskiest the market has faced since the Fed started hiking rates way back when. Is that political relief rally? It might have just cleared the path for a brutal reality check.
Okay, let's pivot now to some individual stocks. Because the action there on Tuesday showed something really important happening under the surface. It feels like the market is finally starting to grow up a bit when it comes to AI. It's moving past just buying anything with AI slapped on the label. We saw what our sources called a violent differentiation, maybe an AI schism. The market seems to be demanding actual proof now. Cold, hard evidence of profitability, executable plans, real long-term roadmaps, not just hype.
That divergence, that schism, was perfectly captured by the stark difference in how advanced micro devices AMD and NVIDIA traded. These are two giants supposedly racing side by side in the AI marathon.
Yeah, let's start with AMD. They were the clear winner, the fundamental story that day.
AMD was just explosive. The stock surged, 9.6% during the regular trading session, and they kept going after hours, added another like 6%, pushing it up towards $252.
Wow.
That's an undeniable bullish signal, and it all stemmed from their financial analyst day. It was like a massive injection of confidence for institutional investors.
What was it specifically that AMD presented that got the market so fired up? Enough for a double-digit percentage gain.
They laid out this multi-year, long-term vision that just blew away expectations. They weren't just talking about the next quarter. CEO Lisa Su basically forecasted that their revenue could grow at a compounded annual rate, a KJR, above 35% for the next 3 to 5 years.
35% CAGR. That's huge.
Just incredibly aggressive growth guidance. And it's almost all being driven by their data center and AI segments. This wasn't just vague optimism. It felt like a firm commitment to a really ambitious path forward.
And they also talked about the size of the opportunity, right? Their total addressable market, the TAM.
Right. And they didn't just throw out a big number. They actually broke it down, CPUs, GPUs, networking gear for AI, and projected that this whole AI silicon market could top $1 trillion by 2030.
$1 trillion?
Yes. Putting that kind of massive, tangible number out there gives investors something concrete to model against. Plus, they guided for gross margins improving into the 55% to 58% range over the next few years. That's well ahead of what analysts were expecting, signaling serious efficiency and, maybe more importantly, pricing power.
And crucially, it sounds like they backed it up with real customer wins, right? Moving beyond just promises, which, like you said, seems to be what the market wants now.
Absolutely critical point. They highlighted deep partnerships, new deals with the big hyperscalers, the major AI players. They specifically name-dropped OpenAI, Oracle, Meta. That's proof of execution. That's the market-rewarding fundamentals over just narrative. And honestly, it's a healthy, necessary sign of maturity in this whole AI trade.
Okay, now contrast that powerhouse performance with NVIDIA, the established AI leader, the stock that's already delivered mind-blowing returns. How did they fare?
Well, despite AMD's great news, despite the general buzz around AI, NVIDIA actually slipped, down about 0.5% on Tuesday, after already dropping 3% the day before. This is where that narrative risk starts to bite. It shows that fundamentals, or maybe the lack of new positive fundamental news, are starting to outweigh past performance.
And what was the main thing dragging NVIDIA down, fueling that AI bubble talk?
It was a pretty major blow to investor confidence, honestly.
Mm.
The news came out that SoftBank, the big Japanese tech investor, had sold its entire stake in NVIDIA. We're talking $5.8 billion worth of stock.
$5.8 billion. Wow, SoftBank makes huge bets, right?
Huge, often very directional bets on disruptive tech. So when an investor like that completely liquidates such a massive position, it adds serious high-profile fuel to the fire for anyone arguing that AI valuations have gotten out of control. SoftBank is essentially signaling, we think this stock has peaked for now, or at least the risk versus reward doesn't look good enough for us anymore.
That is the AI schism right there, isn't it? The market seems to be shifting, moving away from maybe just the first mover story, the narrative risk associated with NVIDIA's already massive run, and moving towards stocks like AMD that can show a credible path to long-term growth and margin expansion with specific multi-year guidance.
Exactly. If we go back to that dot-com analogy for a second, the companies that actually survived the crash back in 2000, the ones that thrived later, they were the ones with real earnings. Real cash flow, not just a massive TAM or a cool story. AMD seems to be providing credible evidence of having that path. Meanwhile, the SoftBank exit just highlights the inherent risk when valuations get so far ahead of current fundamentals.
Okay, so beyond those two chip giants, were there other notable stock moves that kind of reflected this search for tangible growth or maybe just volatility?
Yeah, definitely. On Holding, ticker ONAN, that's the Swiss sneaker company, right? They soared, up over 20%.
20%, just for sneakers.
Well, their catalyst was beating earnings expectations by a lot, posting a bigger-than-expected profit, and raising their forecast for the full year again. It's a classic case of just solid fundamentals getting rewarded big time, even with all the macro uncertainty swirling around.
Okay. And then on the flip side, you had Circle Internet Group, CRCL, the stablecoin issuer. They had a wild ride and then dropped.
Yes, Circle tumbled,
Yeah.
down somewhere between 9% and 12%, depending on the source. And it was a classic sell the news event. What's interesting is they actually did report strong earnings, but the stock had been on this absolutely insane roller coaster ride, running from like $90 up to nearly $300 and then back down again very quickly.
Right.
So strong earnings just became the exit signal for traders who'd ridden that wave to lock in some massive profits.
Gotcha. And finally, IBM got a little boost, tapping into that sort of next big thing, excitement.
Yeah, IBM ticked up about 2.3%. They announced what they described as a breakthrough in quantum computing. The market's always looking past the current hype cycle for the next potential growth narrative. And anything that suggests real progress in quantum computing, which promises this exponentially faster processing power that's seen as a potentially huge high risk, but maybe very high reward long-term bet.
All right, so beyond the macro data bomb that's about to hit, we also have some really high-stakes company earnings reports coming up. These will either confirm or maybe challenge that AI growth story and give us more clues about broader economic health. We need to pay close attention to companies that reported after the bell Tuesday and the ones reporting before the market opens Wednesday and Thursday. See if their guidance holds up.
Let's start with probably the most critical report that came out after Tuesday's close.
Yeah.
Cisco Systems, ticker CSKDO. Cisco is just essential. It's a bellwether for enterprise spending, for networking gear sales, just general corporate capital expenditure trends across the economy.
And the stock actually traded up into the report, right, up almost 3%. So investors were clearly optimistic, maybe hoping that cyclical recovery vibe from the Dow, plus the AI demand that lifted AMD, would show up in Cisco's order book.
Yeah, the setup was definitely high stakes. Expectations were running pretty high. Consensus estimates had revenue pegged around $14.78 billion, earnings per share EPS around 98 cents. Analysts were basically right at the top end of Cisco's own guidance range. They'd priced in a near-perfect quarter.
But with Cisco, the headline numbers, the actual results, they're almost less important than the commentary, right?
Yeah.
Especially their forward outlook. What were investors really laser focused on during that earnings call? What was the true test?
There were really three critical things everyone was listening for, the things that would ultimately move the stock. First, and probably most important, AI networking orders. Cisco had previously said they'd booked about $2 billion in orders related to AI infrastructure for their fiscal 2025. The market desperately needed to hear that that momentum was accelerating.
Why accelerating?
To justify Cisco's own AI story, obviously, but also, crucially, to validate that massive bullish ecosystem demand that AMD had just painted hours earlier. If Cisco isn't seeing a pickup in orders for the switches and routers needed to build out AI data centers, then those huge CapEx promises from the chip guys start to look a little shaky.
Okay, AI orders. What was the second key point? Something about that huge acquisition they made.
Exactly. The Splunk integration. Investors were hanging on every word about how the integration of Splunk, that massive multi-billion-dollar bet on security and observability software, is actually going. Bringing a company that big into the fold is a monumental task. Any hint of friction, delays, unexpected costs, they would hit the stock immediately and raise questions about future profit margins.
Okay. And the third point, the big risk factor that could potentially overshadow everything else.
That would be core networking. This is their bread and butter, their traditional enterprise business, selling switches, routers, the gear that powers regular corporate networks. Any sign of a slowdown here, any weakness in spending from typical large companies on just standard IT upgrades, that's the critical risk. If CEO Chuck Robbins sounded hesitant about standard corporate CapEx, it could completely negate any positive AI news and just torpedo the stock, potentially pulling down that whole cyclical confidence narrative that the Dow just built on political relief.
Okay, so Cisco was huge after the bell Tuesday. Looking ahead to Wednesday and Thursday, what other key reports are on the docket that could move the needle on these big themes, maybe starting with some international flavor?
Yeah, Thursday morning before the bell, we get JD.com. JD. That's a really important read on the Chinese consumer. How is spending holding up over there? What's the health of the broader Asia-Pacific economy looking like? Their EPS estimate is around $2.75. The commentary will feed directly into global growth models, especially important after OPEC flagged potential demand weakness.
Yeah. Okay. And then after the close on Thursday, a couple of giants reporting.
Two huge ones. First, the Walt Disney Company, the IS. The market will be all ears for updates on their streaming business. Are they getting closer to profitability? How are the theme parks doing? What's the latest on their whole turnaround strategy?
Yeah.
It's a key pulse check on consumer discretionary spending.
And the second one after the bell Thursday, this one sounds absolutely vital for the AI supply chain story.
Oh, it is. Applied Materials, AMAT, reports after the close. AMAT makes the complex equipment that companies use to manufacture semiconductors. They are right at the heart of the AI supply chain. Companies like AMD and NVIDIA rely on massive capital expenditures, huge investments to build new chip factories, expand capacity. AMAT's results and, more importantly, their guidance will tell us if companies are still plowing billions into chip manufacturing or if maybe they're starting to tap the brakes on CapEx. Any hint of a slowdown from AMAT would directly challenge those bullish long-term projections from the chip designers.
Right. And we should probably mention a couple of other, maybe more volatile names that reported late Tuesday. Ones where analysts seemed less certain.
Yeah, Flutter Entertainment, FLUT, the online gaming company, they went into their report already down like 27% from the recent highs. And the range of analyst estimates for their earnings was unusually wide, which basically signals very low conviction, low confidence from Wall Street. It was a real prove-it moment for them in what's become a pretty crowded market. And then you had dLocal, DLO, they process payments mostly in emerging markets. Their report is always a useful gauge of fintech resilience and economic activity in those regions. Estimates were around 16 or 17 cents EPS. Any sign of stabilization there would be a positive signal for that whole high-risk, high-reward fintech space. # synthesis and strategic outlook. Okay, so we try to pull all these threads together, connect the dots. What's the big picture takeaway?
I think it's that the market is suffering from this really profound and frankly probably unsustainable divergence. You have the Dow Jones hitting an all-time high, but that feels like a very narrow politically driven event. It was celebrating the end of government gridlock, which, let's be honest, is a pretty low bar for feeling optimistic.
But hang on, if the market, or at least the Dow part, thinks the economy is strong enough to push those big industrial companies to record highs, why is the rest of the market seemingly betting against growth? Why dump oil into bearish contango? Why pile into safe haven bonds? It doesn't quite add up, does it?
It's the core cognitive dissonance, right? That Dow optimism is totally isolated. It's being directly contradicted by almost every other major asset class signal we're seeing. The risk-off positioning in treasuries, that fundamental collapse in oil prices, confirmed by OPEC's own data, the flight to safety we saw in gold, they're all screaming the same thing. The primary risk investors see right now is fundamental economic weakness, maybe exacerbated by sticky inflation. It's not political uncertainty anymore. It almost feels like the market thinks ending the shutdown just means, okay, now we have a clear runway to potentially crash into economic reality. So that faith the market put in a dovish Fed, those hopes for rate cuts that really blossomed during the 43-day data vacuum, that faith is about to have its first major reality test. The CPI data is the crucible. It's the moment of truth. And if that CPI report comes in sticky, comes in hot, not only does that 63% chance of a December rate cut just vanish, but the Fed suddenly finds itself in a really awkward political spot, with maybe the Dow still high from relief, but the underlying economy clearly struggling with inflation.
Yeah, that's a tough position. Meanwhile, down at the individual stock level, that AI schism we talked about, that actually feels like a healthy, maybe necessary development, doesn't it? Seeing AMD surge on strong fundamentals while Nvidia slides on narrative risk, it suggests the market is finally maturing, moving beyond just chasing the hype. Investors are demanding credible long-term growth plans, proof of profit, real customer wins, not just excitement about a concept.
Completely agree. It's a necessary maturation. And that trend, rewarding concrete fundamentals, is likely going to intensify, especially if the macro picture gets cloudier after that CPI report hits.
So looking ahead to Wednesday's trading, the entire session is going to be overshadowed, defined, really, by that 8:30 a.m. Eastern CPI release. The fact that futures opened basically flat to mix just confirms it. The market knows exactly what's coming. It's holding its collective breath, recognizing just how high the stakes are. The takeaway for you, our listener, has to be this. The market is undeniably at an inflection point. It's caught right between the relief, the celebration of a political problem being solved, and this rising dread of an economic problem about to be revealed in hard data. The big question is, did ending the 43-day shutdown just clear the path for a much bigger, maybe more damaging economic event? Or can that narrow political confidence somehow withstand the shock of reality when the data finally lands? #outro, it really is that classic conflict, relief versus reality. You've got the Dow celebrating the politicians finally getting something done, while the bond and commodity markets are bracing for economic shockwave. Thanks for diving into the source material with us today to unpack all of this.
Yeah, it's fascinating, isn't it? We saw the political solution ending the shutdown. It clearly fueled one specific index, the Dow. But the underlying economic realities at OPEC surplus, falling bond yields, surging gold, they weighed on pretty much everything else, which raises, I think, a really important question for everyone to ponder. When that CPI data finally hits, when it either validates or completely demolishes the Fed's dovish pivot narrative, will that political relief rally in the Dow even matter anymore? Or will those fundamental economic warning signs from the bond and oil markets finally just overwhelm the equity optimism entirely?